This is the Royal Financial Investment Group. As always, this is your host here, Prince. Wes is in the building today. Say hey, Wes.
Hey.
Yeah, this is Wes. This is my 4-year-old son, Wes. If you don't know Wesley, that's my 4-year-old son. I like to carry him around a little bit and let him see the little things. I think we all should do, let's all teach our kids and stuff like that. So today's topic is going to be the business cycle. I don't have a lot of time, so I definitely know you guys don't have a lot of time. And what we're going to do is we're going to jump straight into it. So before we jump straight into it, don't forget to hit the like button, subscribe button, comment button, all of the good stuff. And definitely don't forget to leave some comments. I want to get you guys' thoughts, get some feedback. Thumbs up, thumbs down, all the good stuff. So let's jump straight into it. The business cycle. So as you can see here, I have already drawn what it looks like, a type of little ugly little U. But it's kind of going through the cycle. What we got to understand is that in the market and a lot of things, I heard that the two best rules of investments is that one, remember that everything is in a cycle. And the second rule is the greatest opportunities for loss and gains is when you forget rule number one. And rule number one is everything that goes in a cycle, right? So for a prime example, let's start at the beginning of the cycle. Here, when we go here, I blocked off 2 points. In this area here, when the economy is coming back, remember 2008, 2009, don't worry about my writing, it's kind of ugly there, but in 2008, 2009, the economy had crashed, everything was at the bottom. Really what the economy was at a trough. It was at the bottom, right? That's the bottom. That's what the economy was in 2008, 2009. Banks filed bankruptcy, market crash, all of the good stuff. But what we noticed is that, due to stimulus, due to the government stimulate the economy by putting more money back into people's pocket, by boosting up the stock market, by bailing out a lot of people, by lowering interest rates, all these great instruments that the government had, it started to push the economy back up. And what is known as an expansion, I just write an E here. I tried to write the word expansion, but just write an E here. So expansion, that's when the economy is doing good, unemployment rates start to drop, people start to get jobs. When people get jobs, what they do, they spend, right? They start spending. When someone else spends, that's somebody else's paycheck. So somebody else is making that money. Companies are making money. When companies make more money, they produce more and they hire more people, all of the good stuff. So you get to an expansion. So here you're at the bottom. Then the economy started doing good. It started expanding. Then what happens here? What is at the top? I'm going to write a P up here. Stands for peak. That's when the economy peaks. Because, whoa, the thing you got to keep in mind about an asset, like a house or a stock or a commodity, anything that gains value over time, when do people like to buy more? When the price is going down or when the price is going up? Now, I know everybody with common sense will say, yeah, good ideas to buy when it's going down. But when it comes down to assets, when it comes down to buying things, people buy more stuff when the price is going up. So the price is going up and people buy more and more and more and more. But guess what? Eventually, what goes up must come down. Eventually, it's going to hit a peak, right? You're going to hit a peak. And then after that peak, guess what? It starts to decline. Woo! Right? In this area here, we're going to write a recession, also known as contraction. A recession is when you have more than 2 GDPs, gross domestic product, 2 reports of a declining GDP. GDP is a gross domestic product. Everything that we produce within the borders of the United States. So every time we spend money, what we buy, that's known as our gross domestic product. And when we have 2 periods of a declining GDP, when we start to fall off, that's called a recession. The market starts to contract itself. This area right here is called a contraction, right? And then when you're in a contraction, then you end up in a trough, 2008, 2009. Then what's after the trough? I'm going to write a T here so you can understand that. A T for a trough. What happens? What's over here? Expansion. Boom. Look at that. You guys learned already. So you can see how you had an expansion when everything is going good. Employment is going down. The market is doing great. Jobs are hiring. Everything is good. Everybody has money. Then you start to peak off. Then once you start to peak off, then you start to decline. Unemployment rates start to go up. Interest rates start to go up. Banks start to lose money. Things like that. And you can see this is a continuous cycle. Right now, you can say, hey, Prince, where are we at now? Where do you guys think we're at? I was still in an expansion period, right? 2008, 2009, we was over here in the trough. And from 2009, 2010 to about 2015, we pretty much been in an expansion period. So I think we're approaching our peak. So what happens when you approach the peak? What's after the peak? It's recession. Things are going to contract, right? Not necessarily a recession, but a contraction. So this is healthy. The market needs to go up and down. This is what keeps the market going up and down. Now, looking at this, When is the best time to buy? This area. That is the best time to that is the best time to buy. A lot of people don't know that. It doesn't look like that, but it's hard to buy there. Why is it hard to buy there? Because that's when everything is going bad. The news is bad. Companies are going out of business. Blockbuster is going out of business. This bank is filing bankruptcy. This Ford is going out of business. General Motors. And it's hard to say, oh, that'll be a good investment. But that's the best time to buy. When do you think most people buy? When do most people say, you know what, that's a good investment? This is when most people buy at the peak. Because that's when everybody see it's proven. Wow, they see the market is proven. They see all these people making money. And when do most people jump in? They buy in here. Then when they start to lose money, they're like, oh crap, I'm going to sell. And that's how you can have, they forgot that it's a cycle. And guess what? These people are going to lose. But the person that buys here, because what's after that expansion? What is it? What? Peak. Bam. The peak is going to be up here. So a person that buys here and sell it up here at the peak, they buy it in the trough and sell it at the peak, that's when they're going to, those people who are going to be the winners. The winners are going to be over here. The losers are going to be over here. So you can say, okay, how can I make a profit on this? All right, Prince, this is good news. What can I do with it? You can say, okay, you could wait until the next, when you see the things are overpriced, you can short the market or you can buy puts against the market as it's declining. Then when it's at the bottom, you can become bullish. You can buy ETFs into the Dow Jones, into the NASDAQ, into the S&P 500. You can buy ETFs, pretty much essential, or you can make calls on the market when it's in a trough. Or when it's in a peak, you can bet against the market. You can sell puts and stuff like that. But I don't want to bore you guys. I just want to hit that topic. This is the business cycle, something to think about. Don't forget, give me your thoughts. Give me some comments below. Hit the like button, subscribe button, thumbs up, thumbs down. Let me know if it was a good video, bad video, all that other good stuff. As always, thank you guys for tuning in. Until the next video, be safe. Peace.